Six stocks I'm buying now, October 2023 edition. Welcome in, folks. It's my favorite video I do for you guys each and every month. We're about to get into six stocks that I am extremely bullish on and why I'm bullish on these stocks. We're going to go in depth on all six of these stocks here today. I had to put on my orange sweater for you guys, my one and only orange sweater, since I thought it was appropriate now that we're in October now at this point in time. Last month was a bit scary. You'd usually think October's a little scary. September was scary for the stock market in general. Very bad month, to say the least. Look at the indexes. The Dow was down 3.5%. The S&P 500 is down nearly 5%. And the NASDAQ was down close to 6% in the month of September. So a lot of opportunities have emerged over the past few months in the market. And so there's a lot of stocks I'm very, very bullish on. So we're going to get into these six stocks. And I'm also going to share some other stocks that I'm definitely considering that maybe aren't for sure buys for me for this month, but definitely stocks I'm strongly considering as well. So I appreciate every single person for being here. Thank you so much. Thank you for being subscribed, folks. And I just want to get straight into this. I appreciate y'all being here as always. Okay, so first one of these six stocks up here, PayPal. This stock is Mr. Easy Money, I call it, for 2024 and beyond. This stock is very similar to Meta last year. So Meta was a very popular stock that was beaten down heavily last year. It was down about 70% last year. A lot of people had kind of thrown in the trash, and nonetheless, every single person out there wants to buy Meta stock this year. They're falling over themselves. Last year, there was people selling Meta stock at $88. This year, there's people buying Meta shares for $300+. What a difference a year can make. And so I'm not sure PayPal necessarily has that much upside as Meta did last year, but it has a tremendous amount of upside, and I believe a lot of that's going to come to fruition in 2024 and beyond when it comes to stock. When I'm buying PayPal, I'm getting the PayPal service, obviously, which is a monster. I'm also getting Venmo, and I'm getting Braintree as well. I'm getting three extremely exciting businesses. Now, Alex Chriss just literally started in the company basically last week. September 27th, he started with the company, so end of September. He's moving into the position Dan Schulman had before, and Dan Schulman did a pretty good job running the company, but it's a broken stock. It's not a broken company, and there's a big difference. When you come in like an Alex Chriss, and he's coming in from a very important position from Intuit, essentially, which Intuit's one of the best stocks in the market the past 10, 15 years. When you come into a company like this, you can either come in two ways. One, it could be a broken stock. One, it could be a broken company. PayPal's numbers are not broken. The numbers are phenomenal. We're about to go through those in just a moment. But this is a broken stock right now, and he's got to fix really the stock and maybe just tweak a few things in the business to get this, let's call it, roaring once again. Now, the company's trading at about 11 times this year's numbers and 10 times next year's expected numbers, so 2024 numbers. Folks, that is extremely cheap, and especially for a company that is expected to grow high single digits growth over the coming years, year in and year out. This is extremely low valuations, like on the floor. That's why this is a broken stock right now, not a broken company. You'd look at something like this, right? This came out in September. Uber and PayPal are going to expand their relationship, but I thought this was very important here. As part of the agreement, PayPal and Uber will continue to build upon their substantive relationship for global card processing powered by PayPal's Braintree, which Braintree is basically a back-end service that a ton of massive companies use to basically process all their payments and do a lot more. In addition to conventional card processing, Uber will leverage the PayPal Braintree platform to expand its use of domestic debit network routing in several markets, including in the United States. Uber will also leverage PayPal value-added services, including PayPal payouts, interesting, and several other that support in creating seamless, high-performance payment experiences for Uber customers. That's phenomenal. So, Uber and PayPal, obviously two giant companies getting more, let's call it a much closer relationship. And it goes to show you the power of really PayPal. It goes way beyond just like somebody pays with that thing. It's way beyond that, folks. And so you see it in these big relationships here. Now, if we look at the numbers for this company, we can look at it on a GAAP basis or a non-GAAP basis. This is their latest quarter they just reported. Revenues were up 7% year over year on a GAAP basis, generally accepted accounting principles. Operating income was up 48%. Earnings per share were up 414% on a GAAP basis. If you want to look at non-GAAP, some people believe more in non-GAAP numbers than GAAP numbers because you can take one-time things out and whatnot. Okay, non-GAAP numbers, net revenues were up 8%. Operating income was up 20%, and earnings per share were up 24% year over year. So whichever way you slice it, the company has very strong growth. And that's even in this tough consumer environment that we've been going through when it comes to inflation, right? Now, Cash and cash equivalents on the balance sheet of over $5.5 billion for this company. Short-term investments of about $4.4 billion in this company. And don't be surprised if that cash balance builds up over this next, let's call it a couple quarters here. Total assets of the company of about $74.5 billion. Total liabilities of the company about almost $55 billion in total liabilities, which makes for total equity just under $20 billion for PayPal overall. Now, the company's actively buying a lot of their shares back right now, which I think is a great decision. Like, they've been buying a lot of shares back over this past year, and I think this is just a phenomenal time period to take advantage. I do not believe PayPal stock's going to be in the 50s forever. I do believe this is going to be a $100 plus stock, $150 plus stock, and eventually a $200 plus stock again. And so I think the company should take advantage of buying as many shares as they possibly can back right now, folks. And I can't always say that for all companies, but for PayPal, great decision to be buying back these shares. Now, for me personally, when it comes to PayPal, I'm going to be buying the stock until basically the first quarter of 2024. In the first quarter of 2024, at some point in time, I'll stop buying PayPal stock. And the reason being is not because I think the stock's going to be $150 then or something like that, or not even because I don't believe in whatever price it's trading at. It's just I'll have my position built out at some point fully in Q1 of 2024. And it'll just be a situation where there's no need to add any more shares, very similar to how I have several other stocks at this point in time. And so basically, my full position should be finished up within the next 3 to 5 months in terms of how many shares I want to own. So absolutely love PayPal. Throw it in the filing cabinet. I'm very happy with this one, and I think the performance will be tremendous over this next, let's just call it 3 years or so. Alrighty, next stock up here. Second stock of these 6 stocks up here, and I'll also share with you the maybes as well. Second stock is WBA, Walgreens Boots Alliance. This might not seem like such an exciting stock, but don't be surprised if the returns are pretty phenomenal next year for the stock. Okay, the valuation's silly at this point in time in WBA. It's gotten to silly mode. Okay, here's the deal. I think we all know Walgreens is one of the biggest pharmacy chains in the United States of America, right? They operate a little under 9,000 pharmacies in the United States of America. A massive player. If you live in the United States of America, I'm sure there's a Walgreens very close to you, if not several. Okay. The company trades at, we're talking trailing P's, forward P's in the fives. In the fives, folks. Yeah, that's a company that's been thrown in the dumpster can. That's ridiculous. The dividend yield on Walgreens is now over, it's almost funny. It's over 9% for Walgreens Boots Alliance. It's ridiculous. Now, you'd think the company's numbers, they have to be broken. To be trading at P's in the fives and to have a 9% plus dividend yield, you think this company's got to be done. Nope. And nope, okay? This is our latest quarter. Latest quarter, on a constant FX basis, their sales was up nearly 9% year over year. Their net earnings on an adjusted basis were up 3.4%, and their EPS on an adjusted basis was up 3.6%. So this is a broken stock. This is not a broken company. The numbers tell you this is not a broken company whatsoever, but the stock price says it's a broken company, okay? Now, there's a few bad things with Walgreens, right? And I always like to look at my stocks from kind of the bad perspective, the good perspective, everything in between, right? The one bad thing with Walgreens, the balance sheet is not the best. $871 million in cash and cash equivalents, a little under $100 million in marketable securities. They have goodwill of about $28 billion. That's a really high number. I do not like a goodwill number that big, to be quite honest. Short-term debt of about $3 billion, long-term debt of a little under $9 billion. Total equity on the company is about, let's call it $29 billion, but remember, 28 of that's goodwill. So that makes me feel a little uncomfortable. The second bad thing for the company is they're in a CEO transition period. The current CEO, Roz Brewer, stepped down. She couldn't perform. Let's just call it that. She couldn't perform. The stock price kept floundering, and at the end of the day, a head's got to roll, and that's the public markets for you. That's Wall Street for you, and so unfortunately, she's out. And now there's talk that Walgreens could get the former Cigna CEO. We'll see what happens with that. But nonetheless, it's never comfortable feeling investing into a company that is dealing with, let's call it a CEO transition. And then also they're dealing with theft in their stores. Not all their stores, but a good enough number of them that it actually has a material meaning. And when it comes to theft, obviously it's hits to profitability, but also you have to deal with a dilemma where you might have to lock up more of your products, which makes it more inconvenient for paying customers as well. So it's not a good situation. A lot of retailers, unfortunately, are having to deal with a lot of theft right now. And it's something that's going on. And it's just something these companies are going to have to deal with here for the next bit of time. Now, When it comes to Walgreens, once again, it's a needs-based company. At the end of the day, recessions, no recessions, it doesn't matter. People are still going to get their freaking Band-Aids and their pills, okay? 9% plus dividend yield on this one. 5 P ratio, aging population, obviously, in the United States of America, which is going to mean pharmacies are going to do better than ever, ultimately, over the next 20, 30 years. And I like the risk reward. So I'm willing to, let's just call it, add some shares pretty aggressively over this next few months in regards to WBA. Alrighty, folks, next stock up here. Stock number 3 of these 6 stocks, Texas Roadhouse, TXRH. Let me be very clear. Texas Roadhouse is one of the top 10 best stocks in the entire stock market, folks. When I think about the companies, I've been in the market for 15 years now. If I think about the companies that have been the most well-run over the years, specifically over the past 10 to 15 years, there's a few that come to mind. One would be Elf Beauty. One would be Texas Roadhouse. Monster Beverage, which is a company I used to be invested in back when it was called Hanson's Natural Beverage. Apple certainly comes to mind. Tesla comes to mind. And Amazon comes to mind. Those are some of the top tier companies that, if I think about the best run companies over the past 10, 15 years, those ones come to mind. Adobe comes to mind. Intuit comes to mind. And you got this restaurant chain, Chipotle comes to mind, certainly. But there you got Texas Roadhouse, one of the most well-run companies literally in the entire world. It's incredible how well-run this company is. So the company's sitting with about 700 restaurants now at this point in time in 49 states, 661 Texas Roadhouse locations, and 41 Bubba's 33, which is an exciting concept that has food quality about this, very similar to Texas Roadhouse, which is high quality, price is not super expensive, but Bubba's focuses a little more on the pizza and wings crowd versus Texas Roadhouse obviously focuses much more on the steaks and ribs and those sorts of things, right? Now, in regards to Texas Roadhouse latest quarter, revenue was up this is year-to-date numbers. Revenue is up 16.6% on a year-over-year basis. Earnings per share up 16.6% on a year-over-year basis year-to-date. The numbers are phenomenal at Texas Roadhouse. It's the creme de la creme, okay? And I'm not just talking about the creme de la creme in the restaurant space. I'm talking about the creme de la creme, period, in the stock market. It gets no better than a company like this. Comp restaurant sales increased 11% last quarter. Holy smokers, that's no jokers. Average weekly sales at the company restaurants were $147,000. So that means they're doing average weekly sales per restaurant of $147,000, which is $18,762 were to-go sales on an average basis per week for restaurants, compared to an average weekly sales of $133,000 in the same quarter last year, right? So the to-go sales isn't growing much anymore at this point in time. That's kind of a little bit stagnant now that we're out of Rona times officially, right? But obviously their in-restaurant sales are increasing quite dramatically. Restaurant margin dollars increased 11.7% on a year-over-year basis. I mean, that's incredible. Diluted earnings per share has increased 16.6% so far this year. Whew. Primarily driven by higher restaurant margin dollars, partially offset by higher general administrative expenses. The 9 company restaurants and 4 franchise restaurants were opened, and the company repurchased 306,000 shares of its common stock for about $33 million, so they're buying back shares right now. Balance sheet it gets no better than this, folks. It literally gets no better than this. $107 million of cash and cash equivalents on the balance sheet, $2.5 billion in total assets on this company, over $1 billion in stockholder equity on the company. And this isn't like some crazy huge market cap, so this is tremendous. In no long-term debt. It gets no better than that, man. I don't have to deal with any debt. I got a company that's cash loaded, that's super profitable, that's the most well-run you can possibly find. That's the holy grail. It's the holy grail, folks, of investing. Forward P is 17 on this stock. I mean, I'll just be honest. If you talk about many of the top tier companies, which once again, I put this in the top 10 most well-run companies in the financial markets, most of them you're going to have to pay 20 plus forward Ps on them, and many of them you're going to be 30 plus. So if I can get one at 17, I'll gladly take it in regards to Texas Roadhouse. Here's the deal with Texas Roadhouse. Under $100 is a strong buy for me, strong like Donkey Kong. Over $125 is, I'm going to kind of chill back a little bit and let things play out once it's over $125. But yeah, anything under $125 I'm buying. Under $100, strong buy for me. And I'm hoping for consumer weakness in 24 so I can buy this stock throughout 2024. That's my hope. We'll see what happens. But I would love to buy the stock for like a year or two straight. This is not like, oh, let me just buy it for a week. No, this is like one of those stocks. I'll buy as many freaking shares I can get my hands on. Company's buying back shares. I'll buy as many shares as I can get my hands on. Throw those babies in the filing cabinet. Next stock up here, number 4, these 6 stocks up here, and then we'll get into the maybes as well, is Cheesecake Factory. So Cheesecake Factory, another restaurant stock up here. And, the restaurant sector has been hit very hard in terms of stock prices because there's belief of consumer slowdown, a lot of worries around that. I'm willing to step in and take that risk because whatever consumer weakness is in the short term, that's a short-term thing that goes away. Even if there is consumer weakness, which a lot of people said the consumer was going to not be here in 2023. And look at the company numbers. Look at Texas Roadhouse. They seem to be doing just fine when every economist out there said, the consumer is going to be done in 2023. Look at Texas Roadhouse numbers. Those certainly don't say anything done about that, right? Cheesecake Factory operates 323 restaurants throughout the United States and Canada. They have about 30 international locations as well. They also have their bakery division. They have 2 big facilities that produce, obviously, the cheesecakes and the breads and things like that for the restaurants, but they also have a pretty strong, let's call it business of licensing products, and you might even see different Cheesecake Factory products actually in your grocery store as well, from different bread products or cheesecake products as well, and also they can sell to other bakeries, okay? Now, North Italia is just a hidden gem with this company that has so much potential, it's ridiculous. Their comp store sales for North Italia this year up 8%. Up 8% year over year. If you're going to comp them against 2019, there's a 30% up number there. So North Italia is knocking the ball out of the ballpark, and this has, I think, as big of a potential impact as Cheesecake Factory does long term. We're talking about over the next 10, 15, 20 years. Now, they also own this Blanco brand, which I tried that in Arizona. Very good. Flower Child, which isn't my cup of tea, but I could definitely see a lot of other people liking Flower Child. Culinary Dropout, which gets a lot of, let's call it hype. And many of these other concepts a lot of them are in Arizona. So if you're ever in the Phoenix area, you can try out many of these concepts. I tried out a bunch of them. Everyone I tried was freaking good. Like, they're legit. And so, tremendous opportunity, not just from the Cheesecake Factory brand side, but from the North Italia side, and then the other side, their other brands as well. They do a great job keeping their people around. Senior VP of Operations, average tenure 33 years. Regional Vice Presidents, 25 years. Area Director of Operations, 22 years. Area Kitchen Operation Managers, 21 years. General Managers, 12 years, which is arguably the most important position when you're talking about restaurants. Like, you've got to have strong GMs. If you don't have strong GMs in a restaurant business, you're done. You're a freaking done. Executive Kitchen Managers, 11 years. That's the sign of a good company. A good company can keep their people for a long time. If you're constantly rolling through your people, that's a sign you're a bad company. Bottom line, especially in this industry, your people are everything. It's a people business. People think it's a food business. No, it's a people business. Who's making all the food? It's the people. Okay? Who's the ones greeting people coming through the door? It's the people. Who's the one coming to the tables? It's the people. This is a people business. Not a lot of people understand that. They think it's a restaurant business. No, it's a people business. Okay? Now, in terms of their unit volumes, they are the highest tier. Cheesecake Factory, $12.1 million in average unit volume per year. The next closest would be Maggiano's. I don't know if you guys ever tried that one before. I believe it's an Italian restaurant. $8.1 million. Texas Roadhouse, which is one of the stocks I'm buying, obviously, right now. $7 million unit volumes per year. And then you kind of go down from there. Olive Garden, which I'm sure a lot of people know of Olive Garden being one of the most popular restaurants in the United States. Guys, less than half of what Cheesecake Factory is doing per location. Let that sink in for a moment. That's incredible, right? Now, if we look at off-premise sales, that's where Cheesecake Factory is actually growing their business quite substantially, at least in the past few years. If we look at on-premise 2019 versus 2022, roughly the same numbers, but it's really the to-go business. Think about DoorDash business, which Cheesecake Factory has an exclusive deal with DoorDash, and not just for Cheesecake Factory brand, but also for Flower Child and also for North Italia as well. But they're doing very well when it comes to go business as well and delivery business. Okay, now this might be the most important thing when it comes to Cheesecake Factory, right? Because you always want to think, okay, what happens if a recession happens? I understand that's always a worry, right? Which is not even that scary anymore. It used to be the scariest thing for a Cheesecake Factory used to be recession. Then we had a once in 100-year pandemic that all of a sudden all their restaurants had to be closed. That was a new scariest thing, okay? It gets no scarier than that, like, oh, all your restaurants have to close. And Cheesecake Factory wasn't big with to-go food back then. So that was the scariest freaking thing, I can tell you that. When all of a sudden you got to talk about, oh my gosh, like, what's going to happen? Are we going to lose our staff? Like, are we going to lose our restaurants? Yeah, so recessions, Cheesecake Factory, remember, in the great financial crisis, this company wasn't nearly as strong as they are today, right? And look at their free cash flow during those years. 2008, they had $85 million of free cash flow. 2009, $163 million free cash flow. 2010, $128 million. $120 million. Those are extremely weak economic years, right? 2008, 2009, 2010, 2011. And yet Cheesecake Factory got the job done, man. That's incredible. That's incredible, okay? Now, when it comes to Cheesecake Factory, I'm getting this stock extremely cheap. Way cheaper than Texas Roadhouse, right? About 11 times this year's numbers, 9 times next year's expected numbers. I mean, yeah, give me as many shares as possible. So anything under $40, I will eat for Cheesecake Factory. I will eat every share under $40 I can possibly get my hands on. This one I'll probably continue buying for at least the next, I would say, 3 to 6 months in regards to Cheesecake Factory. Alrighty, guys, stock number 5 up here, and then we'll get into the maybe stocks I can potentially buy as well. Okay, number 5 of 6 is Winning Resorts. Winning Resorts, okay, and we'll get into the maybes next. Now, Wynn Resorts, give me the shares. Give me the freaking shares, okay? Here's what I'm getting when I always think about what am I actually getting when I buy a business, right? And here's what I'm getting with Wynn Resorts. I'm getting Wynn Palace, which is the premier property in the Macau region, right? And Macau's just opened back up fully in 2023, which is extremely exciting for the numbers of Wynn for future years here, okay? Also, I'm getting the Boston property, which they sold off the actual property, but they still operate the property, and they're kind of like a sale leaseback type situation in regards to that Wynn property in the Boston Harbor region. If you live in Massachusetts, Boston area, I'm sure you are aware of that property. It's a creme de la creme property, obviously, in that region. Then I'm also getting Wynn and Encore Las Vegas, right, which are the 2 premier properties on the Las Vegas Strip. They also own this nice piece of land right here, which is a phenomenal piece of land because you got Resorts World right here, you got Wynn and Encore right there, you have Palazzo Venetian over here, you got Fashion Show Mall right here, you got the Planet back here. It's it's one of the few, I would call it, great pieces of the Las Vegas Strip that's vacant right now. Actually, it's the only piece of the Las Vegas Strip that's vacant right now that I would truly call a great piece. Any other open land, kind of near the Las Vegas Strip, not very good piece of land, to be honest. There's a piece of land that's way down by kind of like Mandalay Bay, Delano area, not a great location. This is freaking a great location, especially with more and more traffic building on this north end of the Strip. You got Fontainebleau's opening, which is a little down here now. That's going to be opening here in the next few months. You got Resorts World over here. This part of the north part of the Strip is starting to boom. This used to be kind of a dead zone. Not anymore, folks, okay? And then 2026, look at this beauty they're going to be building in the Middle East region, which is going to be the first crazy epic gaming resort in that region. So think about the opportunity there and the sort of money they can make from that property over the coming years. Oh man, I'm going to be very, very excited to see the numbers out of that one over time because I think there's a whole lot of people that are going to be looking to spend a whole lot of money there over the coming years, okay? Now, when it comes to Wynn Resorts, the growth is ridiculous right now in revenues, okay? Revenue growth expected this year is expected to be nearly 70%, right? Analysts on average, 67%. And next year is going to be double digits as well. And so keep in mind, not every year is going to be 67% revenue growth, but they're just, this year has been the big year of opening back up Macau again. So what that's going to produce for revenues for the company and obviously profitability is going to be immense. And you're going to likely see a Wynn emerge over this next few years that's far more profitable than any Wynn Resorts, honestly, we've ever seen in history. And it's exciting because Wynn's been a kind of a dead stock and dead company for several years, obviously. Travel was in a very tough place for a long time. We all know that, right? Here's the best part. Here's the best part of this whole situation. I'm getting Wynn Resorts for pricing that was on the stock back in 2010. So I'm getting this company at basically almost near great financial crisis type pricing, or let's call it just coming out of the great financial crisis type pricing. But it's a company that's far bigger. Back then, they didn't have this piece of land here, right? Back then, they didn't operate this property. Back then, they didn't have Wynn Palace. Oh, by the way, I forgot they have 2 more resorts in Macau as well, the original Wynn property and Encore property that are absolutely phenomenal. So, and they also weren't working on this back then. So think about that for a moment, right? This company's in a far better position now than they were back then, I can tell you that much. And so I'm loving it. I'm absolutely loving it when it comes to Wynn Resorts. Here's the deal with Wynn, okay? It's a buy up to $150 a share for me. Anything under $100, gimme, throw it in the filing cabinet. Gimme, throw it in the filing cabinet. Wynn's one of these stocks that, it has very exciting stock price for a few years where it's just up and up and up and it's just great days. And then it goes through some very tough times. And certainly Wynn for the last 3.5 plus years has been in a very, let's just call it rougher place when it comes to stock price overall. But yeah, under $100, always easy money for Wynn. I don't see it ever changing. I think eventually that's going to be under $200 when it comes to that kind of like easy money number, because I think once this baby kind of gets on a roll, I don't think it's coming back to the under $100 club. I don't think ever again, to be quite honest. That's just my personal opinion on that, okay? All right, guys. Now let's get into some maybe stocks, then we'll get into the last stock, number 6, okay? So the first of these maybes is actually Meta. And here's a tough situation with me. I'm already overexposed to Meta. I have $546,000 of the public account invested in that. The public account's about a $1.7 million portfolio, okay? I'm up $323,000 on the stock, but I'm looking at the valuation currently on the company. I'm looking at the new Ray-Ban product they have coming out. I'm looking at Oculus 3 coming out. I'm looking at what they're working on AI and how much progress they've made just in the past 12 to 18 months when it comes to AI and being like laughed at for what they were doing even in like the metaverse versus what they got going on now. I don't think I have nearly enough Meta, I'll be honest. And that's scary. That's scary. And so Meta is definitely one I'm strongly considering. Another stock I'm strongly considering is Tesla. It's a stock I'm up 960% on, but honestly, it's irrelevant. What matters is where Tesla's going over the next few years. And I believe Tesla has a very exciting 2024 and beyond. We got Cybertruck going to be ramped up like crazy in 2024. I think, consumers have been hit by high gas prices for the last couple of years. I think consumers are tapped out when it comes to paying these sorts of gas prices. And I think most people are going to recognize that EVs are the wave of the future, and the next time they go to buy a new car, it's going to be an EV. And if you're going to go consider an EV for your next car, you're considering Tesla over everybody else. That's actually a pretty easy win for Tesla. And so I just think there's going to be a massive boom for Tesla for years and years to go in the future. And obviously Tesla's benefiting from, the Inflation Reduction Act and everything that they got going on there. There's a lot of incentives for companies like a Tesla that's perfectly positioned there. So it's actually one I think Tesla could potentially go on a pretty big run in 24, 25, 26. And so it's definitely actually one I'm considering buying. We'll see if it happens. Elf Beauty, I'm up 1,400% on this stock. But, I've been looking at the numbers last couple of quarters. They're blowing me out of the water. I mean, the numbers are extraordinary out of Elf. And so it's one I'm looking at and I'm like, the stock might actually be a buy. The valuation looks very high and I've made so much money on it, but it's all irrelevant. The percentage gains and all that stuff, it just matters where Elf's going over time. So that's actually one I'm considering as well. Palantir, the more I've seen with Palantir over this past year, the more and more I'm convinced, and this is a tough one again, we've made a lot of money on it, but it should be irrelevant, right? When it comes to Palantir, this is what I'm looking at, and it's just, I'm more and more convinced that Palantir is, as Dan Ives calls it, the Messi of AI, and they've got such a tremendous opportunity here for the next, decade plus, that I'm just like, and I just think the cash flows this company's going to build out over this next few years is going to be way beyond anything they're doing certainly now, and way beyond what anybody really is anticipating. And I just know these business models, and I know how incredibly profitable they become, and I know how incredibly sticky they become for commercial side and the government side as well. And I see some of these government contracts coming through now, and I'm just like, oh man, Palantir still a buy. It's just, sometimes it's hard mentally to wrap your head around. This stock was just $5 or $6 at the beginning of the year, and now I got to pay $16 for it, right? That's the one kind of tougher thing, like mental barrier to jump over sometimes. It's always, for the 15 years I've been in the market, it's always been one of the toughest mental barriers for me to get over, is like paying a much heftier price for a stock than I paid previously, okay? Dutch Bros is a stock I'm considering. If this baby keeps falling over this next month or so, I'm going to consider starting a Dutch Bros position. They're just starting to get to the kind of that infant stage of profitability, and I think Dutch Bros has such a long expansion run ahead of themselves for this next decade in terms of how many locations they can build out and how profitable his business can be and how many more products they can obviously offer, especially if they want to get more into food over time, which is certainly a decision if they want to make that move, right? So Dutch Bros, long runway of growth. The stocks are going to be in a tougher place here for a bit. But yeah, man, it's one I'm actually somewhat considering, especially if it falls under 20 bucks. That's where things start to get really interesting to me if this baby was to fall under 20. So kind of secretly hoping on that, okay? So those are all the maybes, okay? Let's get back to the number 6 stock up here, these 6 stocks. And this was more of a for sure buy in October, and that is Target, TGT. Stock's been very hit this year, obviously 31%. Some of that's self-inflicted, some of that's consumer weakness and those sorts of things. Here's the deal, okay? So Target's about done with store growth, okay? So they don't need to, let's call it, spend heavily on store growth over the coming years. They have about 2,000 stores or so in the United States of America, so they're pretty built out. So here's how I kind of think about, because I'm kind of thinking about Target over this next 10 years, right? The store network is pretty much built out, and at this point in time, they don't need huge spend in terms of new stores anymore, right? Most of their remodels are done now at this point in time. They got some more stores to remodel, obviously, in 2024, but they got a lot of their stores remodeled, which is very exciting. That's a huge kind of expense that obviously will pay off over this next decade once they get all these remodels done, right? I'm getting a 3.5+% dividend yield that I think they'll be able to up year after year after year, every year for, basically the next decade plus. Obviously, they're continuing to build out their online and delivery business, right? And I'm getting the stock for a forward P of about 15. So for Target, I feel very comfortable paying the sort of price I'm paying right now. And yeah, very, very excited about that one, folks, okay? Hey, I want to make sure you guys take advantage of these 2 workshops for you down there. It's pinned comment. These are absolutely free to access. You need to access these, okay? These are absolutely free. One is, this is if you're in your first 3 years of investing. So if you're listening to this right now and you're in your first 3 years of investing, take advantage of the first pinned comment down there, okay? That's going to be my Investing Foundations free workshop. It's 5 parts. First one gets into why invest in individual stocks. Day 2 gets into what to look for when researching a company. Day 3 gets into portfolio management and managing cash. Day 4 gets into valuing growth stocks, value stocks, dividend stocks. Day 5 is how I know when to buy and sell stocks. So definitely take advantage of that. And then the second one, this might be for a little bit more of an experienced investor. This is how I find 10x stocks workshop. It's about a 30-minute video. That's the second pinned comment down there. Heck, take advantage of both those workshops, guys. Those are absolutely free. You're going to get a ton of value from those. It's a mistake if you don't take advantage of those. Those are a pinned comment down there, okay? Appreciate everybody joining me as always. Hope you enjoyed this video here today. This is a beast for me to put this together for you guys. Much love and have a great day.